There are three likely ways that the elections could influence the housing market, and they are through tax policy, through whatever we do about Fannie and Freddie going forward, and through financial reform. As to the first, as we all know, the Republicans took control of the House of Representatives, and that almost certainly has implications for the sort of tax policy we'll see going forward. We're going to have to do something about the tax code simply because the only way we can close deficits is to raise revenue. We can cut some spending, but there doesn't seem to be any stomach for substantial reductions in Social Security and Medicare. If the Republicans can do that, I would consider it a miracle. And in the absence of that, along with the need to feed war in Afghanistan and a presence in Iraq, we're going to have to look to the tax code in order to be on a sustainable fiscal path. So there are two ways one can raise revenue. One is to raise rates. And again, I think with Republicans having a majority in the House and having more than 40 votes in the Senate, it's unlikely that that's going to be the thing that happens. So the alternative is to look at other aspects of the tax code that could be changed. And one of those are what economists call tax expenditures, which is ways the tax code favors certain kinds of things. And one of the things the tax code has long favored is housing through the mortgage interest deduction. And I could imagine that in the eagerness to get revenue, that the mortgage interest deduction could be scaled back over the course of the next year or two. And the reason I say that is there have been a number of reports that have come out from bipartisan deficit reduction commissions in the last couple of weeks, and they all mention the need to do something about the mortgage interest deduction. I don't think it'll go away, but I think it'll be substantially attenuated, and there's a chance that there will just be a 15% credit that's targeted to lower income people. So what does this mean? Well, for first-time home buyers, probably not very much, because the mortgage interest deduction doesn't do a lot for them anyway, because very often they're not itemizers, because their incomes are kind of low, they're not paying a lot in state and property taxes, and so on. But for the trade-up market, it might really matter, because one of the reasons people trade up is they get a subsidy for buying a bigger house, particularly higher income folks. And so what we might observe is a lower propensity for higher income people to trade up, and they'll do something else with their money. And so this could have a negative impact on the higher end of the housing market. The second thing, of course, is reform of Fannie Mae and Freddie Mac, and I'll talk some more about this in another video blog post. But what we know is, in general, Democrats like Fannie and Freddie better than Republicans do, although Republicans seem to like it just fine when it helps them or their congressional district. One of the things we just saw was a possibility of lowering the loans that qualified for Fannie Freddie status here in California from $729,000 to $625,000. That would have been a very small reform, a very small movement to see what would happen if we started pulling back on Fannie and Freddie, and Congress was unwilling to do even that. So we know something's got to happen. We know the Treasury is going to come out with a report on what to do in January of 2011. But I don't expect radical change, even though I think a lot of people are hoping for it. Either way, what happens in terms of Fannie Freddie reform will have a pretty big impact on housing finance and therefore the housing market. The third issue that people thought might matter as a result of the Republican takeover of the House is financial reform. And there are some Republicans who campaigned on repealing the financial reform bill that was passed, the Dodd-Frank bill. I don't see that actually happening. I don't think there's a lot of political benefit to doing something that's seen as benefiting Wall Street at the moment. And as a result of that, I think the sort of securitization structures that we saw a few years ago, particularly with respect to subprime loans, are going to be coming back anytime soon, because given the rules that are in place right now, it's very difficult to set up these complex structures, or maybe I should say it would be very expensive to do so, so much so that they're probably not very appealing. So that source of mortgage credit that we had fairly regularly 3 or 4 years ago, I don't see coming back anytime soon. This is not a bad thing, but it is something that will affect the market in the years to come.